Hi, everyone. My name is David Kosmeter. I'm the creator of Timing Research, and welcome to Crowd Forecast News, episode number 161 for November 13th, 2017. We will be discussing the 216th weekly report, which you should be seeing on your screen right now while I'm talking. If you have not had a chance to download this yet, just go to TimingResearch.com and you can download the full PDF there. For those of you watching live, I do have the live chat section of the YouTube page open, so if you have any questions or comments, you can post those there during the show. And I have Dean Jenkins back to moderate today, so I'm going to go ahead and turn it over to him.
Okay, thanks, David. And thanks for putting the show together and for inviting me and the other panelists to be here. I always look forward to this. This is a fun forum, and it's nice just to have a discussion with some other professional traders, get their opinion. I often walk away with good ideas and insights, so it's just a good all-around thing. So let's go ahead and looks like we got a great panel. Every folks I've been on with before. But let's go ahead and have everybody introduce themselves real quick, just a minute or two. When we will start with the mad hedge fund trader himself, John. If you'd introduce yourself.
Good morning. This is John Thomas, the mad hedge fund trader, with you today. We're global long short macro. Have a daily research product, issue about 250 trade alerts a year, and we are now up 58% on the year. So glad to see you all.
Very good. Hard to argue with those results. Next on our panel, we have Neil. Neil, good to be back with you. And if you just give folks watching a quick introduction, who you are, what you got going.
Sure. I run a site called Trader Review Stocks and Options to send out a model portfolio every morning that you can copy into your own account. And it's basically a finely tuned portfolio of around 3 to 6 stock picks and 1 to 3 option picks. And I use technical analysis. I use point and figure, which is hardly used by anyone, but I learned it when I was a broker. And I also use the Ichimoku Cloud now for fine tuning entry and exit.
Okay, another cloud guy. I use the Ichimoku Cloud myself. But the point and figure, I couldn't go and figure. When I've seen you show that chart, it is kind of daunting.
Well, that's exactly why I use it, because nobody uses it, and then it works. And the traders on the CBOE use it, and I know because I've spoken to traders that used to work on the CBOE. So
very good.
Very effective, very effective.
All right, so we'll look forward to seeing your of it here live. And finally, we got Christian. If you would introduce yourself, Christian.
Yeah, sure. Thanks, Dean. And David, thanks for having me on again. Always love to be a part of the panel. So I'm the CEO of Tribeca Trade Group. So I specialize in option trading, ETFs, equities, futures, with everything with a focus on trend trading. So previously, my background was director and senior trader, ETF trader with Bank of America Merrill Lynch. I traded just about every product under the sun on an equity desk. I traded for institutional clients. I made block trades, risk markets for those top tier hedge funds in domestic, international, fixed income, commodity, and currency ETFs, which gives me a real nice background, macro trading background. So that's kind of what I've brought to Tribeca Trade Group. We have an all-day trading room that's open where I trade both an option portfolio as well as a cash trend portfolio. So we have a number of services, but I'll get to those at the end. Thanks again for having me on.
Yeah, good to have you here again. I've enjoyed it when we've been on the panel in the past.
Yeah, absolutely.
So I am Dean Jenkins, founder of FollowMeTrades.com, and I am a trader. Been trading for about 20 years. Most of that time trading my own account, and about halfway through that journey, I discovered technical trading, and that's what I focus on exclusively now. Found fundamental trading to be fundamentally frustrating and inconsistent. So now I'm a technical trader, and I run a stock advisory service. We trade stocks and options. I have a trading room that's open for an hour and a half through the open, and then I offer a series of courses to trade my trading method. We're knocking out consistent returns every year. The track record and the details of every single trade are on my website, followmetrades.com. and it's good to be here. Thanks, David, for inviting me back once again. All right, well, let's jump in. Right, we're here to talk about the direction of the markets, talk about the report. I think, David, I looked at the report, and based on your statistics and your algorithm, there's a 55% chance of the market going higher. So let's see what the panelists say. So the first question we're going to deal with is, will the S&P 500 open higher or lower from Monday's open till Friday's close? And what's your percent confidence in that number? In the next round, we'll get into your rationale for it. You can show a chart and explain why you believe that's the case. But first round, we just want to get up or down and what your confidence is. So, John, what do you think? Where are we going?
First of all, can you hear me? Because I see my screen is frozen.
Yes, we hear you great.
It goes down. I have a 75% confidence. It's not 100% because we've had just the momentum in the market is still very high. So, however, I think this tax bill is starting to pee on the parade of the bull market, and the more people look at it, the less they like. So that reduces the chance that it'll pass at all. At the very least, it's 2018 business. So I think it's basically, now as earnings wind down, it's going to be all about taxes for the rest of the year. That's not a positive for the market at this level.
So if you start feeling a few drops, that is not rain. That's what
no, and it's not something you want to get showered on with either.
Okay, we will be watching carefully for that. All right, Neil, up or down? What's your confidence level?
Yeah, down. I'm going to say like maybe 60, 70% down. Sort of like buy the rumor, sell the news. There's nowhere left for the market to go at this point.
Right.
New Fed chair is coming in. I think he might get sworn in a couple weeks, unless I'm wrong. So there's just nothing. There's just no reason to buy. Lots of stocks are starting to fall onto sell signals, even though the indices are holding up, and there's really not a lot to buy. There's just not. There's no catalyst, nothing. So I'm going to say down.
I like, how many
final answer.
How many different ways can you say no? Not nothing there.
Apparently not enough if
Final
you're
answer.
a teenage girl in Alabama.
Moving right along, Christian, are you with the pack, or are you a contrarian to these opinions?
Well, I think for the last time, and I think we were on a couple weeks ago, and in the overall market, it's kind of been the same for me every week. I will say up this week. I said down, I think it was 2 weeks ago with like a 50%, so I could have said up 50%. A couple weeks ago. So I will say up this week, and I'll say 60%. I think we go into reasoning next in the next question, but I'll just kind of share. We've been in an uptrend all year long. There's been a lot of skepticism all year long about tax plans and things like that. Really, I think from now that most companies and we're just about out of earnings season. But I think the earnings results were pretty strong across the board. So really, until companies start to say that they're doing bad and come out with poor earnings, or something really changes with confidence, which I don't think it really has. I think we will hit a bump or two in the road, because the financial media loves to talk about tax plans and political nonsense, and that's what they've got everybody tuned into. But I think the companies that are reporting earnings, and that's kind of been, I really don't think this market is built up on a tax plan. I think this market, been a global market rally this year, and I don't really see anything derailing it in the near future, other than a couple bumps in the road because of a tax plan may not be going through. I think they put unreal expectations into getting that passed by Thanksgiving. So I do think it gets bumpy, but I think any dip, I think people will come to their senses and buy.
Just a quick note, I think that Thanksgiving, I think that's right out of Trump's book, The Art of the Deal, where you first offer a deal that's going to fail, And then when the deal fails, you're supposed to go back to Trump and ask for his help.
Nice.
It's all his plan. It's all the plan.
I haven't read the book. I haven't read the book.
Yeah,
But,
yeah. I glanced through it online, as you can get
Okay.
free PDF somewhere. But then I think I'm going to
Trump
get the
didn't
book.
write it. It was ghostwritten by a guy who's since turned into a Democrat.
Oh, okay. I didn't know.
I could go down a rabbit trail so easily here.
Yeah, none of these guys write their own books. They don't have time. You know, they're all written by kids.
So my opinion, I think we're going down, and I'm 75% on that with John. So 3 out of 4, and it's great that we don't have 100% consensus. It's good to have some divergent opinions. And come Friday, somebody's going to be right, somebody's going to be wrong, but it's all good, right? It's all good. So next round, we'll go a little bit deeper. And at this point, it'd be great. You can share a chart or simply walk through your analysis, your rationale for why you picked the direction you did. So we'll start back at the top of the batting order with John, who was down at 75%. Why is that happening, John? What do you think?
Well, you know, as I mentioned before, this has been the most hated rally in history, and in the end, the haters will finally get their revenge. You know, if you look at the trend of the market, anyone who's shorting this market is probably driving an Uber cab now anyway. You know, they would have been wiped out. But, you know, after earnings are out, we have to wait 3 more months for earnings. And after the tax bill is either done or not done, what is the next driver of the market? And I'm just not seeing any. So, you know, we could have a horrendous dip. Finally, our 3% plus correction in January, where it appears a lot of deferred tax selling is going to hit. After all, you know, why realize a gain this year when if you wait 6 more weeks, you can pay a much lower tax rate? So that has delayed a lot of selling into the new year. And my concern is that it hits all at once.
Okay.
And from here on, we're trading against that likelihood. So it's a very high-risk situation. We're only playing from the short side now. We're short the Russell 2000. We're short bonds up the wazoo. And we're long gold because at least you don't get killed on time decay like you do with the VXX.
You stole my Russell thunder because I'm going to talk about the Russell, but that's okay because there's something super interesting going on with the Russell.
Yeah, there's a lot to say about the Russell, but you go first.
Yeah, so we'll stick to the order though. Neil, you were down at 60 to 70%. If you want to share a chart or just go a little deeper into that, this is the time.
Yeah, I'll just do a screen share here. Okay, first thing, S&P 500. I don't have the cloud up here. Just let me put the cloud up here, even though it'll be way above the cloud anyway. You can see an obvious breakdown here. Maybe a head and shoulders will start, but the real reason, this is the percent of stocks. You can see up here at the top, percent of stocks above the 50-day moving average in the S&P 500. Peaked at around 77.5. Now it's down to 63. This can usually go coast to coast. And so unless this turns around 6%, I wouldn't really think about going long stocks right now. We made some money long gold a few weeks ago using Nugget, and then 2 weeks ago short using Dust, and we bought puts on Barrick Gold, made 75%. So that was awesome. So we're practically out of the market completely right now, just with one trade. But this indicator is fantastic. Market was down in sort of July, August area, and you can see how this goes here. So if you just follow the underlying technical.
Uh-oh.
I think we lost somebody.
Yeah, I think we lost Neil. I wondered for a minute if I was the one lost, but I can hear you. While he's getting back connected.
There he is.
Are you there, Neil?
Am I here? I don't know.
Yeah, we hear you now.
Oh, I might have hit the mute button by accident on my mic. Yeah, so that's what I use. These are point and figure signals, but it's just turned into a linear chart, which makes it easier to see. So yeah, that's what I'm using.
All right. Christian, you were up 60%. Do you have a chart to share, or want to? I know you gave some rationales, or more you wanted to add to that?
Yeah, absolutely. Let me just get the screen share going, and I think I got that here. But yeah, I liked what you guys had to say about mentioning the Russell. That's something that I watch very closely, and this is kind of why I'm in the middle. I do think that the Russell is a great leading indicator. Sometimes you can kind of cheat and see the next move based on what small caps are doing. In my chart, I don't use the Ichimoku cloud, but I use moving averages, which are very similar, I think, to that. So I see that we're right at the 50-day moving average, and I think it's a pretty pivotal point. So again, that's why I'm kind of in the middle between, up or down direction. I think this week could really go either way. I think if we can't maintain the 50-day moving average, I could see us falling down to 143. However, it's a nice, just like on Thursday, it's a nice move back from the lows. So we could easily get right back above the 50-day moving average and possibly, kind of crawl back into a little bit of resistance. So yeah, I'm very much watching that as well. For small caps, for trying to look for a little bit of a clue here. But yeah, I mean, I've kind of when I come on, usually I talk a lot about international markets. I know everyone is focused on what's going on in the U.S. and again with the politics, but I mean, just look at what's been going on with Japan. They're breaking out. They've kind of come in a little bit. I think they got a little bit ahead of themselves. But if you look at the Nikkei, I mean, what a huge rally that's been on through. The Hang Seng continues to push higher. There's no breakdown there either. Shanghai is now joining the party. If you look at a chart of ASHR, which is the Shanghai ETF, China is just continuing to, regardless of again, the pundits on CNBC or, whoever you listen to talking about China's slowing down and everything. I mean, look at this chart of the Shanghai. So I just don't see the weakness. I understand, I like that chart that was displayed of the advanced decline, but I'll be a little bit more controversial. And yeah, so I think that bottomed somewhere around August. I mean, what kind of dip did we have? Down 1%. So I do see that the same thing with the advanced decline line moving down, and so maybe we are due. I mean, we've had a great run the last couple months. The price action in the S&P is, while been very slow, has remained above all the short-term moving averages. I think a dip could be coming. Could it be possible right around Thanksgiving? Sure. I've just have just learn to not to try to predict when we get that dip, but just have some cash ready for it and be able to buy that dip again as usual. And if that happens where we get a dip, as we could see some things kind of deteriorating as we did in August, we were down maybe 1.5% overall. I think it'll be another great dip to buy.
Are we missing somebody?
I was muted. I'm back.
Okay.
Okay. So I was down. This is Dean. I was down 75%. Again, we're just talking about this week, right? From Monday open to Friday close. So, we're on a daily chart on the S&P. We're still in a bull market. No question about that. Has no evidence of it changing yet. So what we're talking about, what's going to happen over the next week. So I'm looking at a 60-minute chart here on the ES, the S&P 500 futures. And, we've been in a bull market for 8 years, but the current leg after that dip that a few other people talked about back in August, right? The current leg has been going on since about mid-August, this move up here. There have been a couple little bear traps where it looked like it was going to correct and didn't. It continued on into record highs. But we do see consolidation right here. We see a thinning of the Ichimoku cloud. We've had price dip below it. And so, it is not going up with the kind of momentum it was. It is definitely slowing down. And then when I look at the, I think my charts are, oh, here we go. When I do look at the Russell, which is the only index that didn't put in record highs over the last couple of weeks. You know, the NASDAQ did, the Dow did, the S&P 500 did. Meanwhile, the Russell has started a meaningful slide down on this same 60-minute chart. You can see it here.
Right.
It's in a downtrend. We are short the Russell. We're trading that with IWM, the ETF. And we're in profit. We're loving it. And it's got quite a ways to go. And, you know, quite often the Russell can lead the other indexes down. That's not a given. That's a, you know, that's a thesis that can draw your attention and be ready for that to happen. I wouldn't trade that thesis, but it does get me ready. And it looks like the S&P 500 is poised. You know, I don't trade until my technical criteria is met, but my criteria would be met if we took out this previous low at about 25.63. If we go below that, there's pretty good down move coming, more than likely, on the S&P, and I think we're going to get it. I think just looking at technical analysis here on 60-minute charts.
Yeah, I have a couple things to say on the Russell. First of all, there's a reason why it leads to the downside. Smaller companies are more sensitive to the economic cycle than big ones. But also, the Russell 2000 actually only has about 1,700 stocks left in it. 300 have disappeared because of bankruptcies and mergers and private equity deals. So as a result of all this, in falling markets, the Russell 2000 falls at about 1.5 times the S&P 500. So in a falling market, you want to be short the Russell 2000, and we're also short the IWM.
All right. We're in agreement. I'm also bullish on gold, by the way, John.
Yeah, right.
Yeah. Not in it yet, but looking for the next move, and I'm expecting it. I'll be ready to trade it when it happens. All right, so we've got through question number 2. We've given our predictions on the market. We've given our rationale for it. Let's go tackle the special question. David does a good job of putting an interesting question in there every week. And this week the question was, when you enter a trade, how do you decide your position size for that trade? Do you use a set dollar amount, a set shares amount, or do you have some kind of risk control formula for that? So I've definitely got a method I use, but let's go through and hear from the panel. And just back at the top with you, John.
Well, we always start out with a basic 10% on option spreads, 20% for outright ETFs, and 5% for outright options positions. And then if we get a secondary dip or rally, we'll double that up, you know, especially if we really like the fundamentals that are lining up. For example, we doubled up last week on our short on the TLT, and that worked big time. So I rarely go more than a 10% position for a single position because risk control kicks in. That way, if you have a complete blow up, you never lose more than 10% of your portfolio. And, you know, usually you can get out with a 5% loss on a 10% position if you still have any time value left in your options position. So we aim at hitting lots of singles. We try to avoid the home runs, although if a home run drops in our lap, we'll take it.
All right. Very good. Neil, how do you deal with position sizing?
Just a sec. I got a calculator for that. Let me see if it comes up. Okay, I can't show the calculator, but how it works is you use something called percent risk methodology. And if you subscribe to my free newsletter, you get a download link automatically. How it works is you gotta position size the trade based on how much you're willing to lose. So typically you're willing to lose about 1% of your portfolio value. So if you have 100 grand, you say, all right, if I get stopped out on any trade, doesn't matter what it is, I'm only gonna wanna lose $1,000. And so what you do is I have a calculator. So you put in your portfolio value, you put in the stock price, you put in the stop point, and then what percent you want to risk, 0.5%, 1%, 2%. And then the calculator will tell you how much to buy based on that methodology. And sometimes its averages around 8 or 10% of the portfolio, but we've had sometimes, 40% of the entire portfolio in a triple leveraged index ETF, because you can time it so well that the stop point is very close. So we've had like 40% in SPXL, the triple leveraged S&P 500. We get a total of 4% move on the entire account in just a couple of weeks. And I mean, you compound that per year, you're looking at around 65% a year. So I think that's by far the best way to do it. You can get my calculator with the newsletter. And for options, if we're just buying calls and buying puts, I just say 1% of your portfolio, because sometimes the whole trade is not going to work for you, but sometimes you're going to get 2, 3, 4, 500%, and that's also a huge gain to your portfolio. So it's the 1% risk methodology, percent risk method.
Okay, 1% risk methodology. Christian,
Yeah,
what's your approach to position sizing?
Yes, sir. And it's all gut instinct and emotion. No, I'm just kidding. So just like, sorry, I always try to throw in a joke, but yeah, it's pretty much uniform across the board. For cash, what I do is I'll look at, basically risking the same dollar amount, which is adjusted by the volatility. So I think it's similar to what has been mentioned, just a little bit different measure, where I'll use ATR. So for position size, I'll look to see how much a name moves per given day. And for my cash positions, I'll try to keep the same amount, usually like 2 to 3% portfolio. And that'll be adjusted by the volatility of a particular name, so that I'm only really risking the same amount of money per trade. In options, it's kind of the same thing, and I'm just joking around with gut instinct. So I really try to take the emotion out, even though when something, what we do on a day-to-day basis is read the tape and look at option flow. And sometimes a trade will look great and everything lines up perfectly, the technicals. But sometimes, it's still, just because everything lines up great, I try to keep the emotion out of it, and I'll use the same type of size with the ability to kind of always add to the position, especially if you're in an option position, because the values can really fluctuate. But I've learned over time just to, even though there's a trade that may hit, in 5 seconds, I may really like it, maybe something that I've been waiting for, but just keeping everything uniform and, just taking the emotion out of each individual pick and just having faith in the overall system.
Okay, so I'll show what I do, and it's my method is really, really close to Neil's with a little bit of a variation on it. So I just use a calculator. I've created one here in Excel. But like if I use this example, this IWM, this Russell ETF trade that we're in, on every chart that I'm trading, I actually draw these horizontal lines. So this light blue cyan line is my entry price. It's where I got in. The red is my current stop. The green is my target. I'm looking at a target for a Fibonacci retracement into a 38.2 to 61.8 zone on this trade. There's the zone, and it's really just a retracement from that last impulsive move up. So I don't go into a trade unless I've got a defined entry, stop, and target price, and I need those parameters before I can think about position sizing. And then, of course, I trail my stop. So our original stop was at the previous high, and then as we put in lower lows, lower highs, lower lows, lower highs, we trail the stop to lower highs, significant resistance areas, where if price goes above that, we would definitely want to be out. And then this is a short position, so I just enter the values here. So if we were to evaluate this trade right now and go, hey, should we still get in? Right? The answer would be, well, let's find out what the reward to risk is and what the position size would be. So it's 146.56 current price, stop 147.50, target is 144.30. So this says we got a 2.4 to 1 risk to reward ratio, reward to risk. So that's still good, right? I don't take anything less than about 1.2. I want to have the ability to make more than I could lose if it goes wrong. And what this calculator does is take the difference between the entry and the stop, and then you can set your account size and the percent risk. I like 2% as a if we hit the stop, we're not going to lose any more than 2% of the account at the stop, right? So 2% for me works in a $50,000 account. That's 1,000. 100K account, it's 2,000. And then this does just a raw, how many shares would you trade, right? Based on just the difference between the stop and the entry. And it says, oh, go short 1,063 shares, which is 3 times the account value. And I got constrained values that say, yeah, constrain that position to be no more than 15% of the account. So I do that. I use the 2% rule that we're not going to lose more than 2% of the account on the trade, and I'm not going to take a position size bigger than 15%. So I just use this spreadsheet to figure that out. And it says, yeah, I go short at today's price, 51 shares, right? We had a much bigger position back when we got long on this thing, or got short on it, but at the current price, that would be a fairly small position to take. So that's how I approach position sizing, and it's all based on the reality of the chart, right? What's the current stop? What's the current price? What's the current target? Does the trade parameters make sense? And then what would be the correct position size at today's reality? So that's my approach to it. All right, good discussion, good ideas there. I think we all agree you got to have some kind of method, right? You can't just wing it and go, wow, that looks great, man, I'm going all in, bet the farm. You got to have a strategy for for overall money management, position sizing, money management, risk management, trade management. All those things got to be well defined in order to be consistent in your trading. All right, well, this would be the time where we all share our current favorite trade, what do you like right now? And probably the folks watching would be more interested in something they could get in now versus I love the trade I'm in that's too late to get in, right? So what do you like right now, John, that folks might be able to get in and follow along?
Well, let's see if I can work the magic of the screen here. And do you see a chart? Let's see. Yeah. Do you see a bond chart up there?
Yes.
Okay. This is my favorite trade in the world right now. It's one of the best trades I've seen in a long time. This is a 6-month chart on the TLT. This is called a classic head and shoulders top. Okay, left shoulder, right shoulder, head, and we're already starting to collapse on the right side. Okay, the fundamentals behind the trade. We're getting a new Fed governor. The Fed has promised to raise interest rates 4 times next year. And the Fed is also about to start selling $4.5 trillion worth of U.S. Treasury bonds, otherwise known as the TLT. Overwhelming supply, no bids. Sounds like a great short trade to me. So this is our core trade right now. And we are using every rally, every one of these rallies we've been selling, but now we're selling on a double position. And if you look at the long-term chart, you can see how important this is. Let's see. There we go, screen share. Yeah. Can you see that?
Yeah, we can see it.
Okay, so this is a chart going back to 2010. This shows the runaway bull market we've had in U.S. Treasury bonds for the last, 8 years. This is a very, very major multi-year head and shoulders top for the TLT. You can see the left shoulder is in the beginning of 2015. The right shoulder is in mid-2016. Here we are on the right shoulder at the end of 2017 with a little mini head and shoulders top in there. So it doesn't get more classic than this in technical analysis land. In addition to that, you have this huge overlay of why interest rates should be going up for the next several years. So we're double short. We're going to maintain that, and people are already making a lot of money off this trade right now.
Okay, short TLT. That's on my radar screen as well. It's not quite there for me yet, but it's getting really, really close. Neil, what do you like right now?
Yeah, I think TLT is a good multi-year trade for sure. The a 10-year rally or so in bonds is just ridiculous. I think 1-year bonds were up 35%. And bonds you'd think are boring, but they're not boring. But the only trade I really see here for the next couple of weeks is possibly U.S. steel. It does a little bit better in a weaker U.S. dollar environment, and maybe there's sort of like a buy the rumors, sell the news type thing before the new Fed chair gets in. That could be a small trade. I'm totally out of gold. We got our winners going long and short on the gold miners, not the metal, but yeah, you might be able to squeak in a little bit of a profit on U.S. steel the next couple of weeks, but other than that, we're pretty much out of the market except for a pick. But I just keep that for my subscribers.
Yeah, I'm telling my customers, sit down and smell the roses. You just have a great year. Doesn't happen like this every year.
Yeah.
All right.
Yeah, you just had a dance with the most beautiful girl at the high school dance. She went home. Why hang around the dance? Just go home.
Exactly.
Right. Best analogy I could think of right now. Just go home.
I'm trying to get my head around that and still stay focused on the topic here. All right, Christian, are you sitting it out with the other guys?
I'm still trying to get my head around the dance analogy as well. So
I'll explain it to you.
I like it. I like it.
Sometimes you just got to go home. Stay out.
So I like the TLT short too. For me, it hasn't triggered yet. I'm watching that 200-day moving average. I want to make sure that the TLT breaks. So that's it's definitely on my radar too. I think just as Dean said as well, it's on the radar. It's one of the things that I look at every morning. But I'm going to cheat a little bit, and I'm going to give you 2 trade ideas, one kind of longer term and one shorter term. So the chart that I have in front of you, this is KWEB, KWEB. This is the China Internet ETF. This is something that I've been playing throughout the year. I've been holding it, but kind of adding here and there, based on how this kind of ebbs and flows. But, inside this ETF, this is your big China Internet names like Baba, JD.com, Wuba, which just reported, a couple other names, BZUN, BITA. The reason why I bring up a couple of those names is because we're seeing a lot of call buying in those particular names. So this group is up, I think, about 67% year to date as a whole. And some of the individual names like BZUN they're volatile. I mean, these things really move around a lot. But collectively, we continue to see call buying in the group. See what BZUN's up 7%. So these things really whip around a lot. The volatility is huge. So I like to stick to the ETF rather than in this group. I think the group playing the individual names is pretty risky. So I like playing the whole ETF. A lot of them, just like JD.com had earnings today, as well as Wuba. A few more are going to be reporting in the next couple weeks. So I think just a great way to play this and to limit your risk is to do it with the ETF, which still moves around. You can see it's up 1.4% today. Any dips, now is not really a dip, nor is it at the 52-week high. So I think it's a great place to kind of stay the course and maybe even add a position, because it looks like it's trying to make that next leg higher. So I like this long term. I think the whole Chinese Internet group is just showing a lot of, we saw what happened with Singles Day, right? Just huge growth. So it's kind of like looking at the US Internet group, your FANG stocks, and seeing how mature that group has gotten. This still, if you look at the performance, really, this is the first year that these things have begun to really run, up 67%. But other than that, for the last 5 years, they haven't really been participating. So I think while it's up a lot, and one of the best performing groups, I think it's still in the infancy of the trend. And then the other trade so I like this one long term. Short term, a trade that I highlighted on Friday was Western Digital. This is a tech name that we really haven't seen too much call buying in or too much interest in the last couple months, and you could kind of see it's kind of a mess of the last couple months. Nice uptrend, but it's been consolidating here for the last couple months, and it's the first time that we've really seen a big call buyer come in months in Western Digital, WDC. So they went to some pretty short dated stuff, November 24th, But how we analyze how we analyze some of these trades that we see on the tape all the time in the trading room is we say, hey, well, somebody's buying. Maybe there's a short-term catalyst. I don't know what it is. I don't see that they're having an analyst day or investor day coming up. But so I went a little bit further out. I went into some December calls, which also were bought on Friday as well. You could always structure your trade any way you want, but I would be looking for this stock to maybe take the next leg higher, possibly get to the 52-week highs in the next couple of weeks. Thanks.
Okay, thank you. And I like your idea, particularly in a volatile sector like that, of using the ETF. And that's actually my trade that I'm showing right now. Is the trade I want to share right now is XOP. This is the Spider S&P Oil and Gas Exploration ETF. And this is a pretty classic Elliott Wave 3 right now. Here's the big move last year, culminating about in January. There's the big move up. Here's a perfect correction through the early part of this year, and now clear evidence of this thing taking off. Right? We're actually trading a couple individuals in this one, and they are really, really nice home runs.
Hey, team, was your pick CLR the last, was it a couple weeks ago?
Yep.
Real nice pick. Just wanted to give you a thumbs up on that pick. Great pick.
Thank you. Yeah, we're up 21% on that and still with it. Thank you. That's been a real. That's one of the individuals we're playing right now, CLR. But we're also liking the ETF, and we're going to be wrapping up CLR and a couple other ones real quick here. But longer term, XOP, really, really nice. It's got a nice higher high, higher low, new high popping up. It's found real support at the Ichimoku cloud, and that's the value of the Ichimoku cloud, is when you break it, that indicates a trend change, and it was obviously correct here. And then it's projecting, very meaningful support areas for this new trend. And so it came down, reversed, took the next leg up, broke the 200 SMA, that's this white line. And that's when we got real interested. When it was above the cloud, proving a trend, breaking the 200 SMA, we got a price target up here above the 61.8 Fibonacci extension. So looking good, right? Looking really good. Got a pretty nice tight stop on this at 34.49, target up above 42 bucks. And that could run all the way up to the top of that zone, up way up there at about $51. So looking really, really nice.
The first
still time to get
nice
in.
the cloud.
What's that?
Cloud are really nice too, usually when you get a breakthrough, and then you can see on your chart there that first bounce is often a great time to get in.
Yeah. And even in this last 2 weeks, it's had a very linear move up. Wouldn't be the least bit surprising to pull back a little bit, right? And then just continue. That's how it moves in a trend, up, higher highs, higher lows, higher highs. So it won't go straight up, but we think this one's a good longer term trade, and it's got real potential up again, up to about 50 bucks maybe. And even if it only makes it to 42, it's still a 50% trade, so nothing shabby about that. So that's the one I wanted to share. XOP looks excellent. And I love trading something like this, just going out in time, out into the spring, March, April, deep in the money, high delta, call option, no spreads, no diagonals, just go long the calls, way out in time, high delta. Don't get out, we expect to be out of this thing before we get into the last 30 days into the theta decay of the contract. So that's my pick for today. And that one you mentioned, CLR, it's really fun to look at. The last time we were on, we were just getting into that, and that thing's gone linear on us. So having some fun with that trade. Trailing our stop. We've taken profit twice. Our stop's well above our entry, so it's a guaranteed winner. Now the question is, how big? Let it run. All right. Well, thanks for sharing your ideas, all panelists. And this is where we're going to go ahead and go one more time back around. Just any closing thoughts, and if you got a calculator or a newsletter or something you'd like to throw a link up there for the folks watching, this would be a good time to do that. So John, just your closing thoughts on the market, and on, if you got a link or something you wanted to give away, it'd be a great time.
Yeah, let me get my slide up here. Still playing with the new technology. See if I can get it up here. Yeah, there it is. Yeah, my service is called Diary of a Mad Hedge Fund Trader. We've been around about 10 years. We offer a global long short macro strategy, which means we try to find the cheapest longs in the world and the most expensive shorts in the world and run a balanced strategy. We're averaging 34% a year for the last 8 years. This year, we managed to clock up 58%. We issue 250 trade alerts a year on stocks, bonds, commodities, foreign currencies, precious metals, energy, and real estate. Basically, we're trading everything all the time, in addition to sending out a daily research newsletter and doing weekly global strategy webinars, kind of like this one. So find me at madhedgefundtrader.com, and I look forward to working with you in the future. If you want to get our research for free, we do send out sample research, and there's a registration page on my homepage.
All right. Hey, thanks, John. Glad to be here with you again. I always enjoy it. And Neil, closing thoughts for you.
Closing thoughts. Sometimes you got to stay in cash. That's what I've noticed ever since back in my broker days. You know, you're going to get there's something called the 80-20 rule. There's even a book I read on it where, you know, you'll get 80% of your gains from 20% of your trades, and maybe 20% of the time you got to stay out of the market. So I'm totally fine with that. If there's not a clear indication to go up and down, we're just going to stay out. And I don't like pullbacks. I don't like to stay in for pullbacks. So right now we're just staying mostly out, and we'll see, you know, what happens. Watching a little bit of the news. I'm not a news trader, but just sit back and see how things pan out.
All right. I like
this. A law that says you have to trade every day of the year.
That's true. That's true. I like dips because I like to trade them down because sometimes they go pretty fast. But you know, everybody's got their own.
Well, no, like when I have a pick, I'll have an objective, and if it's going to move fast, I'm going to get out before, you know, a 6-7% pullback. And then if I think the trend will continue, I'll get in. I just don't like pullbacks. I don't like to hold through them.
Yeah, I like volatility because it creates sweet entry points, but that's almost become an extinct species.
All right, Christian, your closing thoughts.
Yeah, sure. I also don't like the dips either. No, but they are fun to play from the short side. You know, things can move, you know, pretty quickly. Some of the areas that have been built up, they can come in pretty hard. But yeah, I'm actually craving a little bit of volatility too. You know, cash is a position, and you know, right now I've got a decent cash position, and just waiting for, if we do get that proverbial dip, you know, I think a lot of things will become attractive again. But yeah, just, you know, waiting for that. You know, we saw that on Thursday where, you know, we had a little bit of a dip in the morning, and it got bought up pretty quickly again. So yeah, so we'll just have to kind of wait and see. And you know, best thing I could say is just to have some of that cash. Again, cash is a position. And one of my members said this a while ago, which I just really stuck to this. Said, hey, you can't buy the dip if you don't have any cash on the sidelines. So, you know, I think that's a excellent point. But yeah, in terms of our trading room, if you're interested in trying it, I don't really give out. I don't like mass advertise like a free trial. Because you get a whole bunch of jokers in sometimes when that happens and distracts you. But if anybody is looking for for a couple-day trial, they want to check it out for a couple of days, see what we do in action. My email is my first initial and then last name, so cfromhertz@gmail.com. Just hit me up with an email, and I'm happy to give you a couple-day trial into our trading platform and trading room. So again, thank you for having me on. I always enjoy it, and always enjoy listening to the other opinions about what you guys are thinking, which way you're positioning, and what you think for the week. So thanks again.
All right. Hey, good to have you here. So I'm showing my website. Again, I'm Dean Jenkins, followmetrades.com. So that's the website, followmetrades.com. And stock advisory. Here's our running track record this year to date. These are closed trades, and it's tempting because I could close all my open positions right now and blow away the last couple years. But I'm going to follow my rules and stay with it and manage the trades. We try to provide complete transparency. So here's a detail of every single trade we've taken this year, and we've got the previous years listed up there as well. And if you're intrigued by what I got going here, a nice way to jump in is just to sign up for my free weekly market newsletter and follow along there, and then see if you want to go a little deeper. So Beyond the Noise weekly market newsletter, you can sign up for that for free. All right. Well, hey, it's been a great show. I've enjoyed the comments, the conversation with each of the panelists, and hearing your trade ideas, your thoughts on the overall market. And I think we're at a wrap. So David, I'll turn it back over to you to shut it down.
Thanks, everyone. Great show. Just want to remind everyone watching, be sure to hit the YouTube subscribe button if you haven't yet to get updates on future shows. Also, be sure to join us tomorrow night at 9 p.m. Eastern Time for episode number 11 of Analyze Your Trade that I developed with Dean here. But Dave Landry is going to be hosting or moderating tomorrow night, along with Todd Mitchell and Stephanie Kammerman. And I want to thank all my guests again for this week. John Thomas of MadHedgeFundTrader.com, Neil Batho of TraderReview.net, Christian Fromhertz of TribecaTradeGroup.com, and Dean Jenkins of FollowMeTrades.com. Thanks, everyone.